It's one thing to win a trade, it's another to be consistently profitable. Each time on the winning trade, we take a look at successful option strategies that take advantage of the current market conditions through the passage of time. For those serious about becoming successful, consistently profitable options traders, now is the time to build skills in technical analysis, market analysis, and applied volatility to get those results. We have multiple memberships, starting with our Go membership that teaches rules-based trading, and our Pro membership that teaches more subjective trading. For more information, go to lockeinyoursuccess.com/memberships.
Hello everyone, my name is John Locke and I'd like to welcome you to The Winning Trade, but first the required disclaimer material. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and I'm not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and please make sure you are aware of all your risks prior to placing any trades. Also note that the trades and/or results discussed in this presentation are hypothetical computer-simulated trades and/or results. They're believed to be accurately represented as possible. Keep in mind, live results can vary from simulated results for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance, wealth, and success coach with Locke in Your Success, LLC, where myself and my team of mentors are here to help you win in the markets and in life as well. And today, I'm here to take you into the realm of something called high probability options trading. This is where we utilize option strategies to make money from the passage of time rather than depending solely on price movement in order to be profitable. This doesn't mean we're going to win all the time, but it does mean we have a much higher probability of winning than someone who's purely taking a directional bet. And the trading strategy that I would love to share with you today is something we call the bear trade. It's also known as a super simple bearish butterfly. The bearish butterfly is a famous trading strategy that we've traded since 2008 on our options trading for income meetings. The bear trade came into play somewhere around 2019. It's a simpler version of the bearish butterfly, and it is a strategy that we teach in our Go membership within our fundamentals in investing and trading program. And the strategy is very simple for a complex options trading strategy. It's geared a little bit more towards beginners. The strategy is traded on the Russell 2000. It's designed to take advantage of a variety of markets, such as overextended uptrending markets, volatile and very volatile sideways markets, as well as volatile and just smooth downtrending markets. So we have a lot of types of market conditions. The trade does extremely well, and the size can be traded fairly small. It requires a minimum of $5,000 planned capital. In that $5,000, we have a profit target of 30% or $1,500, and we have an exit loss trigger of the same 30% or $1,500. So with that, let's take you to the trade. Bear trade is a strategy that is a butterfly strategy, and it's also what we call a scaling entry strategy, where we enter the trade partially, and then as the market goes against us, we scale into the trade and increase our position size for a period of time, and then we have what we call a rolling sequence. If the trade goes in our favor, we simply exit at a profit. So the trade starts 56 days to expiration. So the example today is going to be our September expiration, and on July 21st, that expiration cycle was 56 days to expiration. We're going to come in with our put options, and we're going to buy a put butterfly here. You can do a call butterfly, you can do an iron butterfly, it doesn't matter. It does matter a little bit for the analytical software as far as your delta numbers and so forth, but synthetically they are an identical strategy. We're going to come in positioned slightly bearishly with our butterfly, hence the name, the bear trade. So what we're going to do here is the asset price is at 1960. I'm going to have a 1940 for my short strikes. The entry butterfly has 50-point wings, and it looks something like this. From there, the downside is quite simple. If the market happens to pull right back down into here, we exit this. Like 99% of the time, that's going to be at a profit. And if the market goes up, we have a scale-in sequence that starts at, in this case, 1980. So if the asset price hits 1980, we're going to scale into our second third. If the asset price hits 2000, we're going to scale into our third third. And then we have a rolling sequence if the market continues to go up. And then, of course, we have whipsaw rules as well. So you're going to kind of see that in the strategy. We don't get fully scaled in, but you can get an idea of what our upside scaling looks like. And then we get scaled out back to the downside, and we can give you an idea of what that looks like. So here, what we're going to do is nothing until the asset price gets over 1980, or the asset price goes under, let's see, it would be 1880. So we have about a 100-point range here where we do nothing. So let's just go to our first adjustment. It was July 21st. Our first adjustment here is fairly quickly, July 28th. What happened in the marketplace, although we don't consider price movement, we can just take a look at the chart, see what happened. We ended up getting a fairly good size up move, and we finally closed, or not closed, but at our checkpoint time. That's another thing we should mention about the trade. We don't sit here and watch the market. We have a time of day that we choose where we're going to see what's going on with the market and see what the asset price is. And if we hit any of our upside adjustment triggers, we will make an adjustment, or downside adjustment triggers or exit triggers. We'll make those adjustments, and then we will wait till the next day. This allows us to trade without having to be concerned about what the market's doing all day long. And that's really good for your time management, or if you want to trade in your retirement, so to speak. So anyway, what's going on here is our asset price hits 1981. That's over our 1980. So we're going to scale in with our second third. Our second third is going to go 20 points over our first third. So we're going to enter this, or another butterfly, at 1960 short strikes. And that's going to look like this. And now we are 2/3 scaled in. So from here, now that we're scaled in 2/3, we're looking to exit to the downside, or at least scale back down to the downside, if we get what we call outside of our tent and we're positive delta. So if you look here, if that happens, that'll probably be the asset price about 1890. And then if the asset price decides to go up to 2000 or higher, then we are going to add our last third. And then if it continues to go, we're going to start to initiate our roll sequence. So here, let's move forward. And the market continued to go up, but it didn't exceed our 2000 number. And now, getting a pullback. Let's just jump to our next adjustment. So this is what we look like on August 4th. If we go all the way to August 15th, what happens here is, let's just go the day before. This is the Monday before. You can see the market's pulled back. We're up $667 on our planned capital of $5,000. So that's a little over 10%. And our actual capital in the position, notice that we don't have that much actual capital. This is fairly common. We only have 1,500 actual capital, and we're up about, well over 30% of that number. So we can get some really good returns on actual capital with this position. If we go to the following day, though, the market kind of starts to fall apart. So what happens is the market pulls back. We are outside our tent, and we don't call outside our tent the dot being outside the line here. We call it being outside of where this expiration line crosses the zero profit and loss line. So we're outside of that. We're solidly positive delta. We're going to exit our upper butterfly, this one here in the 1960s, and that's going to make the position like this. Now, from here, we have an exit point if the market continues to go down of anything underneath 1880. We're just going to exit the trade. We're going to take our money and we're going to move on. If the market reverses and hits our upside adjustment point again, then we'll start scaling in again. So from here, we go to the next day, and what happens is the market pulls back under our 1880 level to 1877. That is our exit trigger, and we're going to close the trade. After the closing commissions is going to be about a $500 profit, which you can see here. This profit and loss does include commissions, but if I enter my closing trades, I can come out to like $499.48, which is about $500. And that is going to make a return of approximately 10% on our $5,000 planned capital, or a whopping 30% of our actual capital in the position. And this happens in only 26 days. And that is yet another great example of the bear trade, this episode's winning trade. If you liked this episode of The Winning Trade, we invite you to like the video and subscribe to our YouTube channel, and also please comment. We love to hear your comments and feedbacks, and I always answer questions personally. Also, make sure you come on over to lockeinyoursuccess.com. That's LOCKE in yoursuccess.com, and discover how you too can follow along with this and many other great strategies as they unfold during our weekly options trading for income webinars that we have for our Go membership. Also, if you go to thewinningtrade.com, that's thewinningtrade.com, you can explore our past winning trades. You can receive free bonus material as well as access to our free trading success blueprint. And while you're there, make sure you check out our free trading performance podcast, where you can learn to skyrocket your trading results regardless of the type of trading you do. If you have any questions, comments, or anything else you'd like to see on the next winning trade, please make sure you throw that in the comments below. I'll make sure I answer your comments and questions to you personally. Thank you for joining me. I look forward to seeing you on the next winning trade.